Good morning. Good morning, and welcome to our Spring CCP Client Care Program event. And for those of you who were just momentarily blinded by the lights, we've turned those off. And if it's too bright on you, please tell us, because again, I still see it bright for you too. So if there's a light shining on you, please tell us. So welcome, and it's a beautiful spring day. We have a power-packed event for you today. I thank you, all of our continuing client care program members, for your participation and for coming all the way over here today to Anne Arundel County Community College. And I'd like to welcome our guests. I think we have more guests today than we've ever had. So thank you for coming, and we hope you enjoy the event and get something out of it. There are two handouts. There are two PowerPoints, actually. One from KatzAbosch and our guest speakers today, the CPAs who have graciously come. And then there's a handout from the Elville firm and the Greenwald firm. So you should have two PowerPoints. There are two separate packets out front, but there's only really two PowerPoints. So if you don't have those handout materials, please let me know. Jeff Stauffer, who's our Community Relations Director, cannot be here today. I think he had a soccer tournament with his kids. So Jeff can't be here, but he says hello to everybody. And I want to thank my lovely wife, Deborah, who's helped us this morning in the back, and Lucy, who is filming this. And so this whole event will be filmed today. And I just wanted to talk to you about that real quickly. How many of you still do not have the video from last event? Okay, is there anyone that doesn't have that? So if you don't have that, we have that video for you and we want to send it to you. So please let us know. Let Deborah know in the back and write your name down, and we're going to get that to you.
I think that's Social Security talk.
Yes, and thank you, Mark. So that was the Social Security talk that we had about 2 months ago, 3 months ago. Okay, so let us know about that. Now, our next event is a social event, and we're going to have that in June or July. Gary, do you want to come on up? And we wanted to take a poll this morning, if you don't mind. How many of you would like to go to Toby's Dinner Theater for the social event, or how many of you would like to go to another baseball game? So maybe we could see a show of hands for the dinner theater. Okay, I see a lot of hands, and we'll have to get more scientific here in a minute.
That's all the science I think we need.
How many want to go to the baseball game? All right, so we've got, I think the majority is the dinner theater, but let's do it one more time. How many for the dinner theater? Okay, well, okay, majority wins, I think. So Gary, would you describe that event?
Sure, we haven't figured out the date yet, but this summer Toby's Dinner Theater is presenting the production of Mamma Mia, which is a musical based actually on the music of ABBA. So if you like ABBA, you'll enjoy the show. And if you don't know who ABBA is, you'll probably still enjoy the show. We haven't yet figured out if we're going to do a weekend evening show or a Sunday matinee show. We're working on that now. Should we take the poll and see?
Yes, please.
So if we had a choice between either a Friday or a Saturday evening show, or even a Sunday evening show, or a Sunday matinee, the Sunday matinee would begin about 11 a.m. for a brunch. Who would prefer an evening performance as opposed to a matinee? Okay. And who would prefer a Sunday matinee? That's pretty even. You may have to do two of them. So we'll figure that out. One more time. Evening show. No fairway waving both of your hands. All right, and Sunday matinee. So we may end up just finding out where we have the better opportunity to come, because they look pretty split. All right, is there anybody who simply could not attend the matinee program? All right, is there anybody who simply couldn't attend an evening show? It starts at 7 or 8 o'clock. You haven't been much of a help, but thank you very much for trying. We'll figure it out. It looks like it's going to be Toby's probably at the end of June, or most likely at the beginning or the middle of July.
Okay, thanks, Gary. And again, we want to get started here very shortly, but I wanted to thank you again for your commitment to continuing education. And along those lines, I wanted to make sure that I just remind you, you have access to us. So if you have questions, concerns, something that you want to get updated, let us know and make it clear, and we're going to make it a priority. I also wanted to mention something I mentioned last time. Our Annapolis studio, our audiovisual studio, is up and running. So for those of you who are, thank you, Dan. For those of you who are interested in making a family archival video of some kind, that is now available to our CCP members as part of your membership for either the Greenwald firm or the Elville firm. So let us know if you want to get some video going, a family video. Also, we could take some still photography of your family members. So whatever is motivating you along those lines, let us know. All right. Without further ado, we're going to get right into the introductions here. So we're very fortunate today to have two CPAs from KatzAbosch, a very well-known firm in Columbia, Maryland, and James Eaton is here, and Michael Andrews, and thank you, gentlemen, for taking time out of your Saturday. And I'm just going to start with their biographies very quickly, and then they're going to present for about 35 or 40 minutes on the 2017 Tax Act. James Eaton is a principal at KatzAbosch in its tax department, and he's a co-chair of the firm's personal financial planning group. Since 2013, James has worked alongside clients' trusted advisors and attorneys, investment advisors, and insurance providers to help navigate the increasingly complex environment in which we live to achieve family, business, and philanthropic goals. Clients' objectives often include issues such as tax-efficient intergenerational wealth transfer and structured philanthropic giving plans. James provides business and income tax advice along with trust, gift, and estate planning services for clients. He received his bachelor's degree in business administration from Temple University and his MBA from the Purdue School of Business at Salisbury University. James is a professor at Towson University School of Business. He is the treasurer of Christ Lutheran Church Foundation and is a member of the American Institute of CPAs as well as the Maryland Association of CPAs.
And a father
James
of two.
Eaton, and a father of two. Any soccer games today?
No, they're little ones.
Oh, okay, very good. Very good. And Mr. Michael Andrews is a CPA, and he's a supervisor at CPA with KatzAbosch. He joined the firm in 2014 and is a member of its tax department. Michael provides a full range of accounting, tax, and advisory services to closely held businesses and individuals, including income tax planning and compliance, accounting for closely held businesses, compiled financial statements. He's a graduate of the University of Findlay, and his Bachelor of Arts degree he got there, and his Associates of Applied Science and Accounting degree from Community College of Baltimore County. Michael is a proud member of the Leadership Baltimore County Class of 2017, as well as Baltimore County Chamber of Commerce, Emerging Leaders Circle, and the American Institute of CPAs and the Maryland Association of CPAs. With that said, James, please come up.
Thank you. Super.
Welcome.
Thank you. So, Steve, I think first of all, maybe we'll just try this. We're going to try to see if we can just do natural voice, right? Do we need to get lapel mics? What do you think? Should we? Can everybody hear us? Do you want us to mic it up? What do you think? No response. That's perfect.
They didn't hear the question.
Yeah. Right. Sorry. What was the question, Greg?
Let me just make sure you can be heard on video. Lucy, should James use the microphone for video purposes? Yeah, sorry.
Well, we'll make it work. So,
We could just pin.
we'll hand it off.
Yes.
Yeah.
Okay, so, how's everybody this morning? Wow, right? Super. We're inside, it's dark, it's beautiful outside, so we'll try to keep this brief. So, we're not sort of your typical CPAs, Michael and I. Michael, as you might have heard in his bio, had a previous life. Michael's a school teacher, okay? And we love that, right? Education is so much of what we do, but it's also so much core to society, right? What we do as a society. So Michael's a school teacher, and then he came over to the dark side and decided to be an accountant. Now, I've been counseling against that for years, but nobody listens to me anyway, because, well, I'm married, and I know what it's like not to be listened to. And I'm also sort of not your typical green visor accountant guy. My background is pretty diverse and varied. So what we try to do is be very practical about tax reform. And you're thinking like tax reform, like, okay, these guys are gonna get up here and tell me about code sections and stuff like that, and we will do a little bit of that, all right? But what we're really gonna try to do is tell you about, yeah, okay, there's some really technical stuff, but let's wrap it up into what this really means, right? What it means to you. The first thing we gotta think about is tax reform itself. And the last time we had a big tax reform was Reagan in '86, okay? in 86, think about the world in 86, think about the information revolution we had in the 90s and the early 2000s, right? You literally couldn't have done what we did last year in 1986. What do you mean, James? Okay, think about 1986. The 1986 Act was passed in October of 1986, and the law was implemented 1988. So you have 14 months to figure this out. We can say that's plenty of time. But in reality, right, in 1986 when the law was passed, newspapers came out with articles, law passed. Great, okay? There was no hyperlink. How were you supposed to? Oh, there were computers, right? The whole world was different. So a law was passed, and then went to the office of printing, they printed books, and they sent them to CPAs, CPAs read books, and then they read articles, the articles went into professional publications, they were picked up by newspapers, and the average people read articles, right? In our case, a law was passed, and 17 days later it was implemented, right? So, from a planning perspective, that limits what we can do, okay? So right now today, you are living in the New World Order. That doesn't seem any different to you, right? But for the average American, it will seem different a year from now. February, March, April of 2019, when the 2018 tax returns are filed, people will go, huh, that's different. And so that's where we are, right? So what we're trying to do is say, hey, here's an overview of some of the things you've heard about, some of the things you've read about. There's a couple public service announcements in there. There's some misinformation we need to try to go over. And then there's illustrations of what does this mean to real life families. So that's what we want to do. So as an overview, we're going to hit on some business changes. Okay, so maybe there's business owners in the room, maybe there's not, but these kind of fill in some of the thought processes. We'll talk about the qualified business income, the pass-through deduction that we heard about in the news so much. Talk about that, and then we'll talk about the impact to individuals and families in America. We'll finish off with a few notes on estate, trust, and gift taxation.
All right. So I'm going to go over just a few general business changes that impact businesses here in their tax returns. One kind of overview of the tax reform was to lower taxes, get more money back to taxpayers, as well as from a business perspective, incentivize them to spend that money. Right? So the depreciation rules were changed in order to incentivize businesses to spend that more money in capital investments. So bonus depreciation prior to the act allowed you, or a taxpayer or a business, to deduct 50% of a capital asset immediately, of new assets purchased. This was changed so that now, when you go out and buy a new capital asset, you can expense 100% of the cost of that right away. In addition to that, used assets qualify for bonus depreciation now. So it doesn't even have to be something new. If it's a used asset, if you bought it, you can expense the whole thing in year one, as opposed to 50% depreciating over X amount of years.
Right, so now you've got accountants talking about depreciation, right? How boring a thing could you come up with for Saturday morning? But this is based in economic theory, okay? Stick with me a minute. With me? This came about, this idea of bonus depreciation has been bandied about for a number of years, but really it took its own in 2006, right? Remember thinking about 2006? Everything was terrible? You remember that? Okay? The idea here is if you go to businesses and you say, hey, if you buy a Caterpillar tractor, if you buy some servers, right? You're talking about big, expensive things used in business. Hey, we'll give you a deduction. We'll let you deduct $100,000 of that if it's a $100,000 piece of equipment. Well, great. Okay, some people will tell you that's a giveaway to business. Okay, maybe it is, right? Maybe it is. But more importantly, what is it? It means that $100,000 tractor piece of equipment really only costs that company $60,000 or $65,000 or $70,000, right? Which means they can go out and buy more of them, right? Because they save the taxes on it. So they get a $100,000 deduction. The tax rate, let's just call 40%. Now all of a sudden they save $40,000 in taxes. So the tractor only costs them $60,000. Now supply and demand tells you that if the price of a thing is lower, you will sell more of it, okay? And then you gotta have more overtime shifts out in Wabash or wherever they make Caterpillar tractors, okay? And then those people make a little bit more overtime money. What do? They take their family out to dinner, right? And then the waitresses get more tips, okay? And then they have to drive back and forth to work, they buy more gasoline, right? And this is whether or not you believe in it, a concept of kind of Reaganomics, trickle-down economics. You incentivize people to work, and then that's what you do. So this is really an idea whose time is come from an economic perspective. It's also part of the Republican orthodoxy to say, we want to do this to incentivize people to reinvest in their businesses. The other thing that Michael mentioned that was really powerful is, for years and years, you could do this on new stuff, things you bought from the factory, right? Well, now you can do it on pre-owned equipment. So what does that mean? Well, if you have a privately owned business, right, if you were that kind of person, and let's just say you're a construction company, you've got cranes, and you've got bulldozers, you've got trucks, and all these sort of things. When somebody comes along and buys it from you, and they say, well, hey, listen, I want to buy your business and I'll pay $5 million for it. And you say, wait a minute. Okay, wait a minute. You're buying $2 million of trucks, tractors, and equipment. Now, I know the tax code, and I know that you're going to get a $2 million write-off, right? So really, this company's not costing you $5 million, it's costing you $4 million, all right? So, let's split the difference. Instead of paying me $5 million, pay me $5.5. I get a little bit more, you get a tax savings, and that's how we're going to make this work. So it's really very powerful for American privately held businesses.
Thank you, James. Kind of moving along, another goal of the tax reform was to simplify the code, right? We heard that a lot. While not much of this is any more simple, one area that they tried to simplify was the accounting methods. So this is kind of a definitional change. What qualified as a small business, the threshold increased to $25 million of revenue, which pretty large business. So what this allows them to do is use some different accounting methods. They can use a cash method of accounting as opposed to accrual method, as well as, if you have long-term contracts, you can use completed contract versus percentage of completion. So those were some simplified accounting methods. And lastly, one point I want to touch on is the corporate tax rates did decrease from 35% to 21%. So it's those businesses that are C corporations that pay the tax at the entity level got a tax cut. Kind of segueing into our next.
An interesting point to make there, Michael, right? We talk about C corps, we talk about this 21% tax rate, right? And this is what's in the newspapers, yes? Everyone hears about this? Okay, the statistics say that 75% of the business done in America is done by, quote, small businesses. These are the pass-through entities. These are LLCs, they're sole proprietorships, they're S corporations. They're not the names of companies that you see on the NASDAQ or the New York Stock Exchange, okay? So while this is powerful for Google and Apple, right, it kind of doesn't have a whole lot of impact on regular Main Street America. Okay, so it's good, and that's great, but it's an important thing to realize that while this makes the news, it's not necessarily the thing that affects you or me or regular people. Another point that we looked at is there's been changes in the meals and entertainment deductions. So for a business, normally you'd be able to take clients out to dinner and that sort of thing, deduct 50% of it, and now you can still do that. You can still take the client out to dinner. Now what you can't do is entertainment anymore. Entertainment is now non-deductible. So we were made privy to an interesting email between a client of ours and a guy named Peter Angelos. Does anybody know that name? Right, yeah, okay. So the email said, Mr. Angelos, could you please ask Chris Davis not to swing at strikes in the dirt? Which that didn't work out. And then it also said, Mr. Angelos, could you please bill me $1 for my seats and $26,000 a year for my parking? Now, why would that be? Because parking is a fully deductible expense, and the tickets are non-deductible, okay? Now, Mr. Angelos is also married, and so he said, we'll see. Now, does any of the married folks in here know what we'll see means? Right, it means no, okay? But these are the types of things that have been kind of straightened up in the tax code.
Good question.
Oh, sure.
Let's assume you've been buying tickets for your business. Rather than taking the client out of the business, what if you simply were to make a gift of the ticket to the client? Do you deduct it then?
Sure. So the question is, hey, what if instead of buying tickets and then going out to the game with my client, what if I just give them the tickets? So the rules for gifts under the tax code say that you can't really deduct a gift more than $25 to any of your clients, okay? So that's a 1986 number that's not indexed for inflation. So at the time, $25 would get you some flowers that you would send to somebody, a box of chocolate, something like this. $25 is now the delivery fee, okay, for edible arrangements. So you can gift them the delivery, not the arrangement, but the delivery fee. That's what you can give them. So the answer is no. The answer is that the tax code doesn't like that. And they really don't love entertainment because they say, you know, why do we need to incentivize the Ravens to have more season ticket holders in their box seats? The NFL pumps out money, why would we do that? So no is the answer to that one. So if we look at those things, right, we're going to change here so that we can touch base on any questions before we change gears a little bit. Great, no questions. Okay, so the next thing we're going to talk about is the pass-through deduction. Now this is a concept that we as CPAs and as attorneys and investment advisors, we know what this means, right? The average American never used this terminology in their life until November of last year when it came out in the newspaper, and I'm getting calls from clients saying, what about the SALT deduction, and what about the flow-through deduction? I'm like, hey, my clients must be the smartest clients in the world because they're using all this professional lingo, right? No, it's just in the newspaper. Not that they're not the smartest clients in the world, or something like that. Okay, so this is stupid complicated. Remember, this is the Tax Simplification Act. So this is stupid complicated, as you would expect. Conceptually, what do you have, okay? For pass-through businesses, think about this with me, pass-through businesses, LLCs, sole proprietorships, family-owned kind of things like that, S corporations, maybe a trust, a business trust. Simple thing, right? Hey, if you've got $100,000 worth of profit, we're just going to give you a $20,000 deduction right off the top. Fabulous. I'll take it, right? Well, then they went, well, but we don't want people to get too much benefit from this. We really want to use this as just like the bonus depreciation, we want to use this to incentivize some kind of activity. So they said, well, if you're a low-income earner, a single person making less than $157,000, or a married person, married couple, making less than $315,000, you're sort of middle America, you can just have the deduction. So, hey, I'm let's just say I'm single, and I'm one of these computer programmers, works at home kind of thing, subcontractor sort of deal, make $120,000 a year. Hey, I get a 20% deduction. So I'm deducting, $24,000 right off the top. What does that do? It drives my tax rate down 5 or 6% compared to what it was in prior years, okay? So this is, hey, you're too small of a fish to be worried about this, right? Now, if you're bigger than that, then you get into this testing. So you have the first thing you have to worry about is, am I a, quote, good business or am I a, quote, bad business? Do I have the little red guy or the little white guy, right, on my shoulder? The good businesses are really, most trades or businesses. The bad businesses are specified service trader businesses, okay? Vocab words, they're these things, okay? People that are in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, okay, brokers, insurance guys, things like that. But engineers and architects are specifically excluded from being bad. Engineers and architects qualify for deduction. Why? You know that orange guy? What does he do for a living? The dude in the White House? Right? Real estate. What do these dudes do for a living? Real estate. Wait a tick. I mean, I'm dumb, but I'm not that dumb, right? Okay, so if you're one of these things, okay, and my lobby, the very nice AICPA that you guys talk about, didn't do a very good job here because my situation, my accounting firm, okay, we don't get this deduction, right? You would have thought the CPAs would have gotten that written into law more appropriately. All right, if you're one of these things, you're bad. And if you're architects, engineers, or anybody else that's doing making of widgets or real life work, okay, then you're good, okay? So if you're good, then you have to test and you have to say, okay, do I have wages or do I have equipment? And there's some limits there, okay? And if you're bad, if you're an accountant, accountant, lawyer, attorney, medical, professional athlete, that sort of thing, you don't get a deduction at all. Before we go ahead, why don't you ask us a question?
You don't get the deduction unless you meet the income test. Right?
Well, okay, so, right, let's go back. If you're under these income thresholds, you get the deduction, no questions asked, okay? If above these income thresholds, questions asked, okay? The question becomes, one, am I good or bad? If I'm bad, go away, right? You don't get this. If you're good, then you have, if I use the term means testing, does that make sense to you? We're gonna say, are you employing people or are you buying assets? They don't want people that are not contributing to society using this deduction, okay?
Question.
Sure.
The 157 to 315, is that your adjusted gross income?
It's total income. So it's total income. Oh, so the question was the definition of 157 versus 315. What is that? It's not adjusted gross income because adjusted gross income has adjustments. For instance, it has, if you're self-employed, it would have your retirement plan contributions, or it would have your health insurance and that sort of thing. Okay. So this is a total income number. Okay, before adjustments. Okay. So that's a lot of mumbo jumbo. What does it mean? Okay. Let's look at these folks. Okay, married folks. Okay, so we know the income threshold is like 3 something. Okay, these people are at 200. Okay, so we know we're below the threshold. What does that mean? It doesn't matter if we're a good business in this middle column or a bad business in this right-hand column. We're below the testing threshold. What do we know that means? That means you get the deduction. So both of these folks get a 20% deduction, 20% of this $200,000 amount. Okay. So if you're single shingle attorney, you're a web developer making $200,000 a year, and you got a $40,000 tax deduction. Is that $8,000 or $10,000 a year in tax savings? That's a pretty big gig, right? Not a bad gig at all. Okay. So this is when we're income below threshold amounts. Now, if income goes up, if we have income above threshold amounts, then that's where these columns become important, right? Am I a good business in the middle column, or am I a bad business in the right-hand column? If I'm a good business, I say I got $1 million, and I've got a $200,000 deduction, and so my deduction is then limited to 50% of my wages, so I end up with a $100,000 deduction. If I'm a bad business, it doesn't matter what you put in the rest of these fields, okay? I get nothing, okay? If I'm an accountant, if I'm an attorney, if I'm in medical sciences, I'm a professional athlete, I'm a consultant, I'm an investment advisor, I don't get this deduction, okay? So it'll be really powerful for privately held businesses, okay? But let me tell you this, with me, on my desk, because I'm a dork, on my desk, he was gonna say yes. That's a fact. On my desk is the tax code, 4,500 pages in 2 volumes like this, yes? Next to it is Treasury regulations. Okay, it's 6 volumes. I don't know, it's close to 6,000 pages. Okay, now just stop and think about this for a minute. That means the tax code, the law, is about 1/3 of the size of the regulations promulgated by a whole bunch of civil servants that are not elected by anybody. Okay, a conservative estimate is that roughly half of the tax code out the window. Okay, roughly 1/3 of the Treasury regulations out the window. Okay. But most importantly, what are we losing? We're losing 35 years of case law, of adjudication of Supreme Court cases and circuit court cases, where people said, the IRS came along and said, you don't get that deduction. People said, well, IRS, I do too, right? And the law said, okay, you have rights to go through this appeals process. And a lot of the things that we do in the tax code, the things that we all know and love, were adjudicated through the system, right, through the courts. We don't have that anymore, okay? So there's a lot of gray area here. Now remember, starting January 1st this year, you're all living under this new law, yes? Okay? Do you know how many regulations we have for this really powerful piece of law? Yes, somebody said 0, right? 0. We have 0 regulations. They might get them out in September. That means you will have been living 9 months under a new law that you had no explanation of. Thanks. Yes? Okay, fun fact, on average, how long does it take for a case to adjudicate itself from, hey, I disagree with you, IRS, to the Supreme Court? 7 years. 7 years is the answer, okay? How long does this tax law in effect? It's in effect from 2018 to 2025, which is 7 years, okay? There's every chance that somebody will be adjudicating this up through the tax courts, through the circuit courts, to the Supreme Court, after this law has sunsetted and the law has changed. Dig it. That's government, friends. Okay? All right, so the thing about this is this, okay? There's a ton of stuff going on here. If it applies to you, call somebody, okay? Call your broker, call your investment advisor, call your attorney, call your doctor. Right, and say, listen, I know this applies to me. I don't know how it applies to me. I need Open your Rolodex and send me to someone, right? If this applies to you, call somebody and ask for help. Before we switch gears, questions?
I heard something on the radio the other day that there's been a huge increase in the number of LLCs.
Question was, I've heard on the radio that there's been a reported tremendous increase in the number of people registering as LLCs. And is this why? I don't know, but I think probably yes. Okay. Having said that, there's no reason to do that. So I've got 50 calls. People go, hey, I'm a sole proprietor, I'm an attorney, I'm an accountant, I'm whatever I am. Should I make myself an LLC so I can get this pass-through deduction? Hey, babe, you're allowed to. If you're a sole proprietor, a partnership, an S corporation, or a business trust, you are a pass-through and you're qualified for this. So the state of Maryland's happy because every LLC that's registered has to pay $300 a year to be an LLC. So they're like, sure, $100 million. Come on, everybody be an LLC. I'll take $300. They're not dispelling that rumor, right? There is no reason. There is literally no reason, no difference between being an LLC and being a sole proprietor. Now, there are some very nuanced differences between being an S corporation and a sole proprietor. That's beyond the kind of purview of what we want to do here. Okay. So, yes, and also misinformation. Good? Okay, we're going to move on. All right, so that's all pretty cool. Michael's going to talk to us about how does that affect us individuals.
So, and I'm glad it's printed in color because this is James's pride and joy.
That's not true. Michael, so I used to have a slide that I didn't like a whole lot. I said to Michael, I don't like this slide a whole lot. He said, well, that makes sense because it sucks. And I'm like, well, thanks, buddy. And he said, well, let's do something else. We came up with this, which I think is a really good...
Right, so this is kind of the foundation of how people are going to save money on their taxes under the new law. So on the left, we have the stacked tax brackets that pre-2008, so that's under the old law. This is how your income was taxed as it increased. As the more money you made, the higher tax rate you entered into, and the taxes you had to pay. On the right-hand side, we have the new tax brackets, and the same stacked version of what the new rates are at the rising income levels. So we'll start at the bottom three tax brackets, which go from 0 up to about $125,000, $150,000. Right? So this is, middle America, middle class families, typically making about $125,000, $150,000. So what we see here at 10%, the first X amount of dollars, no tax cut. However, everything that they've made up above that, they're going to see about a 3% tax cut under the new law.
Right, Michael, and I would say for the working class family making like $60,000 or $75,000, 3% tax savings when you're living on every dollar you can generate makes a difference.
So then we go up into kind of the next tier, right? The next above 150,000 to about 350, right? So we see prior to 2018, all of that money was being taxed at 28%, 33%, right? But under the new tax law, and this is where, you hear the tax brackets got longer, or the tax rates went down and the tax brackets got taller, right? So we see the 24 area there in that blue color got much longer. So the income that you were paying 28%, 33%, a good chunk of that now is going to be taxed at 24%. And
Right, so
then
this
into
is a really
32.
powerful part of the tax reform, right? So middle class families are right in here, $125 or something thousand of income, right in this area, okay? So they're saving 3% on most of their income, right? We'll look at some examples, but average American families saving some thousands of dollars. Maybe they're not going to Disney for a week, but maybe they're going for a weekend at the beach, right? This, okay, is basically targeted at a lot of business owners. There's a lot of businesses that are making this kind of money. So look at this, stay with me, yes? Okay, in the new tax law, you got 24%, people making like 150 to 315 are paying 24% marginal tax rate. They were paying 28%. If you were making $200,000, you were paying at a 28% clip, and now you're paying at 24, you're saving 4 points, right? Not bad, not a bad gig, yes? But this is really powerful. From 230, okay, to 315, the better part of $100,000, there's a 9-point delta there, okay? What does that mean? It means on this 85 or 90,000 bucks, you're saving 9%. That's like $8,000 of tax savings, okay? So if you live right here, this is you, 315, you save a smidge here, you saved a smidge there, you saved a chunk there, you saved a pile here, okay? We're seeing people $315,000, and this was a hypothetical thing, and I've seen, we've been through busy season now, and we've looked at these people in real life. Folks saving $12,000 to $14,000, you're making, $350,000, saving $14,000 in taxes under tax, $1,000 a month in taxes, okay? That's pretty powerful there. And Mike will tell you, you see the same thing up here in this 35% bracket.
Yeah. So, moving on from James's pretext explanation, the same thing applies as you make more money, right? Yeah.
Is that adjusted gross?
This is taxable income.
Repeat the question.
She asked if that was adjusted gross income. This is your taxable income, so after deductions. Yep. So again, you're going to see above 400,000, some of that is going to be taxed at the same 35%. However, above 500 or above that, you're going to be saving another 4 points on the 35, what was essentially 40, and then above 600, you're going to be saving 2%, right?
Now, arguably, if you make $600,000 a year, you don't need a tax cut. But I digress.
So, back one, just bookmark this slide, because when we go through the examples, you're going to see, well, they lost all these deductions. Their taxable income is higher, the tax went down. How could that be? It's because of this. That's how that all worked. So, yeah.
I guess maybe I don't understand taxes as well as I thought I did, but if we are all paying less in taxes, how can the United States government continue to run based on the
Michael, this is a political question. Watch out!
Borrow $1.5 trillion. Borrow $1 trillion.
So, the question was, if everyone's paying less taxes, how does the U.S. government continue to operate?
Well, you see, we print our
with
own
less
money.
money? Right.
The truth of the matter, if you're willing to accept this answer, is you don't have to worry about it, and we do.
Right.
We'll pay that off when you're gone, and thank you very much for your help.
But great question. Debt is the answer.
Credit cards, right? National credit cards.
And that was discussed. This is going to increase the deficit.
But it can be political.
Your slide says married filing jointly.
Yeah, correct.
How does this change for a single person?
So the question is, hey, at the top in the header it says married filing jointly. It's just an illustration. So this is a stack of income. This is if you had a married filing joint couple making whatever level of taxable income. By and large, if it was a single person, the numbers are roughly cut in half.
What is that?
The income, right? So
The tax brackets are about half of what they would be. So that would mean that if you were single and you made $125,000, which is sort of here for the married folks, your tax brackets would be shorter. So all the tax brackets would be cut in half. So you'd be at the highest tax bracket around $350,000 or $400,000 for an individual, a single person. This 24% tax bracket, instead of running from 150 to 315, would run from like 85 to 160 or something like that. So the tax bracket is basically just cut in half. Is that okay?
Yeah, it would be nice to have the slide.
It's an illustration.
Sir, could you explain what effective tax rate is?
effective tax rate.
Oh, jeez. Okay, question is, what is effective tax rate? That's a definitional question, okay? What most people would say, what is my effective tax? You call your accountant, you say, what is my effective tax rate, right? I want to know for each, if I can have $10,000 of more income, how much do I get to take home? What is my effective tax rate? Effective tax rate basically means just that. At its very core, how much net dollars do I get over how many dollars of gross income? So if I get $7,000 out of my $10,000, I've lost 30%, so my effective tax rate is 30%. What does it mean in clinical terms? You go and you look at what's your federal tax rate, and then add your state tax rate, but to the extent you get a deduction for, some things, whether they be tax credits or a tax deduction for state tax payments, which is kind of the old law, then you net all that back mathematically to say, okay, my federal tax rate is 33% and my state tax rate is 8 3/4, but I get a little bit of tax benefit for paying my state taxes. So my effective tax rate is 33 plus 8 3/4 minus these deductions, and it ends up being 41 or something. Okay?
Definitely get all that.
Do that on your head?
So these are marginal tax rates, and I think of it's probably an average, and I know that's wrong, but average tax rate is kind of where my mind goes when effective tax rate.
Yeah, well, and that's a great example, because Michael and I work together all day long, we totally disagree on this, right? So, because I think you're saying, hey, if I made $1 more, how many cents do I get to bring home? And Michael says, well, talk about my whole stack of income. So if you're here at $300,000 and you're in a 24% tax bracket, your average tax rate is not 24%, right? Because you got all these lower tax brackets down here. So if you're living right here at $300,000, your average tax rate is probably like 16 or 18%, because you get all these lower tax rates, you get income tax at these lower tranches. So happy to have that conversation maybe a little bit further after, right? Okay, so let's talk about some of the changes to individuals under the new
Right. So another goal of simplification, we'll look at the top 3 kind of bullet points here, and these were attempts to simplify the code. The third bullet point is where I'll start. Getting more taxpayers to take a standard deduction as opposed to itemizing, right? To simplify that method. So what they did were double the standard deduction to get more people to take that deduction as opposed to itemizing.
So there's some statistics there, Michael, right? So for the most recent year for which statistics are available, which is the 2014-15 federal fiscal year, roughly 54% of Americans took a standard deduction. Okay, that means they didn't have to itemize, they didn't have mortgage and charity and all that kind of stuff. They just took whatever the government gives them. Okay. This, the Office of Management and Budget, OMB, says that they anticipate 71% of Americans for the 2018 tax year will file a tax return with a standard deduction because they doubled the standard deduction. So it means really only those that have significant mortgage balances and those who are really, really charitable will take an itemized deduction. Now that makes it easier, right? So the IRS doesn't have to audit you if you take a standard deduction. They don't have to go, hey, you took $32,000 in charity to Goodwill. How many T-shirts did you take to the Goodwill? Was it a box truck? Right? They don't have to audit you. They just go, okay, take the standard deduction. Okay? And then there's no audit that they have to do. So that's one of the things you see there.
Right. So that went from single filers, went from roughly 6 to 12, and married filing jointly from about 12 to 24. Is where those numbers lie. Back to the first bullet point. Personal exemption. So this was an exemption of roughly $4,000 that you got to take for each dependent on your tax return. That was repealed. And this is an area where they've been trying to tighten up for a few years now, because at one time it was, you didn't have to have a social security number for the dependents that you claimed on your tax return.
Right.
So
when I
you were
started
claiming.
this industry, it was very common. You could put all your grandparents, you could put 3 different kids, your neighbors, your cousins, your spouses. And then they said, okay, you have to use a social security number, and that cut down on that. But now you still have this problem, and especially like in Chicago, where they put dead people on the voter rolls, they also put them on their tax returns. So we don't have that anymore under this situation.
So the $4,000 deduction or exemption has been repealed. And you might think, well, families with lots of kids, lots of dependents, that they're going to be hurt by this. So to kind of compensate for that, the child tax credit has been increased to $2,000 per child. And we'll see a very good illustration of that, an example of a family of 2 children losing the exemptions, but now having the credit, and you'll see how that kind of offsets.
Yeah, we'll talk about that. I mean, one of the things you heard, if you were into the news, I don't recommend, is that, hey, this tax reform is taking advantage of people with bigger families. I'm going to argue it's the opposite of that, and we'll show you some of that illustration a little bit later. Okay, so there's a couple things here that I get to talk about because this is a little bit of Jimmy's public service announcements, okay? Thing number 1, we're just kind of skipping around here. So salt deduction. Does anybody know this terminology, salt deduction? Okay, this is one that's in the newspaper, right? You've heard this, yes? This is another one of these terms that wasn't something that regular people talk about. That was a Michael and I kind of conversation, and now people talk about it. State and local tax deduction. Okay, so one of the biggest deductions that people take on their tax returns, especially in our area, is the state and local tax deduction. You get a federal itemized deduction for your property taxes and the income taxes you pay to the state of Maryland, okay? Great. Well, those are limited. The Republicans wanted to totally do away with them. They came to an agreement that said, okay, we'll let you have $10,000 of this deduction. Okay, so let's just say you make $200,000 a year, you live in the state of Maryland, and you pay $10,000 in property taxes and $16,000 in Maryland state income taxes. You would have gotten a $26,000 deduction in 2017. In 2018, that's capped at $10,000. Give you another example. I have a client who lives, well, let's just call it Miami, who pays $125,000 a year in property taxes, okay, and $4 million a year in state taxes, okay? His deduction is limited to, yes, anyone want to guess? 10,000, yes? Right, you guys. So then you heard the state of California saying, we're going to set up a charitable fund. This is political payback, okay, for people that vote something other than orange, okay? I'm a Republican. Okay? Smoke and mirrors, folks. I'm telling you, this is the God's honest truth, okay? People in high income tax states have high income. While you were putting that number on your tax return, you were subject to the alternative minimum tax. Don't raise your hand, but in your mind, okay, think about if you're subject to the alternative minimum tax. Don't raise your hand. If you're subject to the alternative minimum tax, what does that mean? It takes your regular tax, it adds back, it says you don't get a benefit for your state and local tax deduction or your property taxes, and it says you don't get a deduction for your miscellaneous itemized deductions, which are like investment advisory fees and stuff like that, okay? So if you were subject to the AMT, okay, you weren't getting this deduction, okay? High income earners in New York, Massachusetts, Maryland, California, they weren't getting this deduction under the old law, okay? All that we've really done is made the regular tax what used to be called the alternative minimum tax. What have we done? We've taken away the state and local tax deduction, we've taken away the miscellaneous itemized deduction. That was the same thing the alternative minimum tax did in the old law, okay? So you've been told that the red people in the middle of the country are really taking it out on the blue people on the edges of the country. This doesn't change. This is the same way it already was, okay? Smoke and mirrors. Okay, PSA number 2. Mortgage interest deduction. I'm going to ask you to raise your hands on this one. Anybody heard, read, had any concerns about the deductibility of mortgages? Have you seen this sort of thing? Seeing nodding, seeing hands, yes. Okay, so the law came out, the Wall Street Journal ran an article that said, the days of the HELOC, the home equity line of credit, are over. Bankers running in the streets, right? There's a definitional problem here, folks. And the problem is the definition of home equity debt, right? So you and I think home equity debt is a second mortgage, right? So Heather and I, my wife and I just bought a house, did an 80-15-5 program, right? A first, a second, and then money down, so you get a PMI, all that sort of stuff, right? You're cool, you're okay, okay? I have a friend who was really concerned. He was in the middle of a construction to perm. He bought a lot and was going to build a house on the lot, construction to perm financing. Oh my God, it's a refi. I'm not going to get to deduct my mortgage on my home. Listen to me, this is the important part. Definition under the tax code of home equity debt is any debt, okay, that's not acquisition debt. Home equity debt is not acquisition debt. So you would say to me, thanks tax code, that's worthless, right? What is home acquisition debt? Home acquisition debt is that debt used to purchase, build, or substantially improve your home, okay? So you buy a house, okay, it doesn't matter if you take a first, a second, a third, or fourth mortgage, you're buying a house, right? Like buying a construction to perm, you're building a house. That's the, hey, you took $100,000 out of the equity and you built the sunroom in the back, maybe the pool, you finished the basement, you know, the second offset garage. All of that is acquisition debt. You're allowed to take it, okay? What can you do? Boat. Can't buy a boat unless it has an enclosed head and a separate steam sleeping, in which case it's a houseboat. Well, that's about it. You can't get used to pay down credit card debt. You can't use it to pay for Johnny's education. You can't, okay, as you used to do, go right down the street, okay, to the Mercedes dealer, okay, and you go over to that financing guy in the corner who says, hey, I'll finance your brand new S-Class for $100,000 on a home equity line because then you can deduct the interest. Okay, you can't do that, right? But if you're buying a house, you're building a house, you're improving your house, you're okay. So when people tell you, oh my, refis are okay, as long as you're doing it for rate or for term, you're okay. You can't take the cash out and go to Vegas question. Here's the patio of your house. Substantial improvement. Okay?
I had read, maybe you can shed some light on this, that people with a house on the south side of Long Island, because of this, they were forming an LLC for the house and then doing some, generating some rental income on it, but then enabling them, the implication was to continue to utilize that deduction.
So the question was, I saw this article, right? It said, rich people turning vacation homes into rental properties. The question was, aren't rich people on Long Island making their vacation homes into rental properties so they can deduct all this? Maybe so, but, this is the fun part, that's always been the rule. You could always have done that, right? So you would take it and you bifurcate it. You say, okay, I use the house personally 100 days, and I use the house for rental 100 days, and so 50% of it is personal and subject to these rules, and 50% of it is business, and you're fine, right? If you own a business property, just say you own a company and you also own the building that you're in, and you got $1 million facility, you can deduct all of your earnings. This is only one for your personal home, okay? Last point on your question, right? Won't all the rich people in the Hamptons rent out their house? No, right? Because they don't want somebody else in their bed. Never done, one answer. Okay, thanks, we're gonna move on. Michael?
So, a couple of changes here for, really, what we want to point out, alimony expenses are no longer going to be deducted. On the flip side, if you're receiving alimony, it's no longer being taxable to you.
So, if you're gonna get a divorce, you'll see your attorney now.
Right. So that comes into effect in 2019. So prior to that, the alimony would still be deducted. Just another point, and James has already kind of went over this, the AMT, the alternative minimum tax, because of the laws of the deductions that we talked about on the other slide, is really the new tax law.
Yeah, the one thing from an investment perspective that you might think about is there's some idea that you take your traditional IRAs and you roll them to Roth IRAs so that you can not be taxed on the growth, right? And that's used tactically for a number of reasons, right? That's a thing that you can still do, but there used to be a rule in the pre-18 law that said if you do that and then the market tanks, okay, you can undo it and not have to pay taxes on this conversion. The IRS basically determined that was impossible for them to police. And so you can still move from one to the other, but you can't undo that. Did I see that?
Yes. On the medical expense, I think that's only for 2 years and then it goes to 10%.
Yeah, so it was 7.5% for a long time and went to 10%, but 7.5% again. And 2 years is kind of a magic number because, I don't know, people tell me that maybe we'll have different people in power in DC and we're not really sure what anything's gonna happen. So the question is, what about medical expenses? So you see that term 7.5% floor. Okay, the easiest way to think about this is an illustration. Let's say you have $100,000 of adjusted gross income. Remember we talked about that. $100,000 of adjusted gross income. And you've got $10,000 of medical expenses. Okay? I hope you don't, but if you did, okay? 7.5% of your AGI, your adjusted gross income, 7.5% of $100,000 is $7,500, $7,500. You don't get a benefit for the first $7,500 of medical expenses. So in our scenario, if you had $10,000 of medical expenses, you get a $2,500 deduction. Now what if, as is the case in 2017, that floor is 10%? Well, your income's $100,000, 10% of that is $10,000, your medical expenses were $10,000, you get 0 deduction, okay? So this is really powerful for folks maybe that are going toward assisted living and that sort of thing, where that's a really big important deduction. And we'll see that the individual mandate is designed to be, intended to be repealed in 2019. We'll see if that happens. That, my friends, is political. The intention is to get young, healthy people off of healthcare programs and cause the Affordable Care Act to crumble under its own weight.
Can I go back to your comment about the Roth characterization?
Sure.
You said you can no longer do that. Does that mean you can no longer recharacterize, or there's no longer a tax implication?
So the question is, let's go back to the Roth thing. What does that mean? You could and can take from a traditional IRA and roll to your Roth and pay taxes on any earnings. You used to be able to go, oh no, the market went down, let's undo that, and I don't want to then pay taxes on that. In 2018, you can't undo it, so you can't save the tax. Once you move from the traditional to the Roth, You're stuck. Yes? Yeah. We'll try to be brief on these two. Why don't we go, Madam?
Can we just go back to the previous slide about charitable contribution limits?
Sure.
Can you explain what happened to that?
So the cash contributions were limited to 50% of your AGI. Right? So you could donate up to, and take a deduction up to 50% of your AGI. That limit has increased to 60% of your AGI.
But the rules otherwise haven't changed.
One more question on this slide. For people who tried to maximize their SALT deduction and they paid their real estate taxes on December 31, will they be able to deduct this year's taxes in Maryland last year?
Don't you answer. Please consult your tax advisor. We're not going to give you an opinion on that. I like my license. Okay?
He asked
Oh, I'm sorry.
those people who prepaid their property taxes as of the end of 17, can you deduct that? And James, you should advise your tax advisor. You should seek counsel from your tax advisor.
Right, so the IRS said, and the tax law has long said, that you can't pay 20 years worth of taxes to take a deduction, right? So you see people, we see people all the time, that have a liquidity event. They sell their business for $10 million. And they're like, golly, look at all that income and all that tax. Well, could I just pay 10 years worth of my Maryland tax, pay state of Maryland $1 million and never pay them again? And I'll take a deduction and that'll save me. No, right? The tax law says that you gotta be paying tax for the year in question, okay? So, yeah, Baltimore County said, come on down, we'll take money. But they didn't give you a legal opinion that said you get to deduct it on your federal tax return. They just said, you got a check? We got a checking account. So this is one of these huge pieces of misinformation. If you recall, probably don't, I did. I've never seen anything like this in my career. On Wednesday, the Wall Street Journal read an article and CNN picked it up that said, prepay your state taxes. Because some guy in Chicago said, prepay your state taxes. And so clients started calling me going, hey, listen, I got some money saved up. Should I prepay my state taxes? Wait a minute, stop. Number one, no. Number two, you're not going to get a deduction. Number three, you're getting the AMT. You're not getting this deduction, okay? Well, I read it, CNN said, are you guys sure? No, you know what, I made it up. You got me. I am unsure. Thank you for clarifying. Right, no, okay? So then, on Thursday, the IRS, I've never seen this. The IRS issued a press release saying, just to clarify, for the past, since 1960, it's been our position that you can't just prepay this stuff and take a deduction. And it was specific to state taxes. Why they did that, I have no idea. Okay? So then people went, specific to state taxes. Let's go prepay our property taxes. And local governments, being tax-strapped as they are, went, yeah, that's a great idea. You know, okay, if it sounds too good to be true, it probably is. Okay? We should probably just try to keep going.
Yeah, we need to pick up.
Michael's giving me the old, let's move it or lose it. Okay. Notes on education, here we go. A lot of people may have heard this. Some folks in this room might be applicable, your kids might be applicable to your grandkids. 529 plans are now usable for K through 12 education, up to $10,000 per year per student. Okay, that's great. So I got people calling me all the time, going, hey, listen, should I put $20,000 into the 529 and the next day I take it out and I pay tuitions? That doesn't save you anything, okay? Listen to what I'm about to tell you. The savings, the benefit of 529 plans is the long-term growth. You put $10,000 into a 529 plan, you leave it there for 10 years, and it goes to, what did I say, $100,000? $100,000 in a 529 plan, leave it there for 10 years, it doubles, $200,000. Use the $200,000 to pay for college, okay? Great. You get no deduction, you don't get income, you don't get whatever else, you just pay $200,000 in tuition. But what did you avoid? If you had put $100,000 in a taxable account, you'd have been paying tax on the dividends every year, and then when you sold, you'd have to pay capital gains. By virtue of putting it in the 529 account, you take $100,000, it doubles to $200,000, you never pay taxes on the gains, okay? The whole power of the 529 plan is tax-free gains. There is no magic putting it into the 529 plan and 3 weeks later paying tuition. There's nothing there, okay? This is a long-term kind of plan, okay? Michael, there's still that rule about gift splitting, right? The averaging?
Right, so because the benefit is long-term. You can pre-fund the plan of up to $75,000 of a 5-year averaging to get the money in there sooner, and then you would just file subsequent gift tax returns each year.
Right, so that's really applicable to grandparents funding the kids' 529 plan that's in your kids, the grandchildren's parents, right, the middle generation. The middle generation owns it, right, for the benefit of the kids. When the grandparents put money in, it's a gift, and so you need to file gift tax returns, there's some special rules there. And what about maximums?
Currently, there is no federal maximum on a 529 plan. However, there are state maximums. In Maryland, it is currently $350,000 per beneficiary. Because of the rule change and private schools in Maryland being very popular, there is an expectation that that could increase.
Right. So once you've got an account balance of $350, you can't put anything more in.
Right.
All right, kitty tax. Michael always makes me do this slide because, well, it's a pain in the actual, right here. See that? Pain in the neck. If you know what kitty tax is, I feel sorry for you, okay? This is for children that have unearned income, okay? Long story short, here, you used to have like a very tiered tax scenario, whatever. Now, basically, kitty tax is trust. You're treated like a trust. The trust tax rates are the most punitive tax rates in the tax code. So this is really an expensive way to get. All right, so here's the best part. We're going to try to run through these because we need to be sensitive to time. But these are examples. Let's take everything we talked about and give you real-life examples in the next few minutes. Michael, please.
All right, so the first example is for a single filer. Let's say they're shortly out of college, making $75,000 a year. They don't own a house. They're not married. Taking the standard deduction. So prior to the law, got a $6,000. It doubled to $12,000. They lost their personal exemption. The math works out that taxable income's about the same. However, as we saw in those tax brackets, if you flip back there, if you want to look at that, he's getting or he or she is getting about a 3% tax savings because of the lower tax rates. They're going to save about $2,000 in tax.
And that's good for the economy, okay? Because bartenders need tips, all right? And that's all going to the bar, all right? Either that or Mexico, which I'm not trickle down, right? I'm not sure this is the type of wall that we need with Mexico, but I mean, I guess $2,000. Hey, Mexico, here I come, right? All right, what else?
Fast forward a few years. This individual is now married, has a couple children, income's up 175. Itemized deductions that you'll see at the bottom. James went over how those are being limited. So what was a $31,000, largely because the state and local taxes are limited to his $10,000. He's going to lose a little bit of his state deduction. The personal exemptions are repealed. So 4,000 and change times 4, he's losing that $16,000 deduction. However, remember what we said about the child tax credit. He lost the exemption, income went up significantly, tax rate, a little bit of savings, but the credit that they are now getting at $2,000 per child, we see the tax savings of about $4,000, which is equal to the credit.
Again, we're not going to Disney for a week. We're going to Ocean City. All right, so look, remember smoke and mirrors? Okay. These people are in a 25% tax bracket. You guys with me? Okay. They lost a $16,000 deduction. What is 16,000 times 25%? $4,000. Yes? Yes. Okay. Woe is me! I have lost $4,000. However, I get $2,000 a kid. I got $4,000. That is a net zero change. Okay. So remember when I told you that I wasn't totally believing that this was hurting bigger families? Okay. I don't think it was. You got 4 kids. Okay? All of a sudden you're getting an $8,000 credit right there. Okay? I think bigger families maybe are better off. Okay? So, we're not going to Disney, we're going on vacation nonetheless.
All right, so next example we're going to look at, someone making $300,000, $350,000, maybe a junior executive at a company. The itemized deductions, again, capped and significantly down.
Deductions, Michael. I'm the one. The tax reform is going to hurt, right?
In addition to losing the personal exemptions, taxable income is up. However, if we look back at the chart, right, most of that income is being taxed at a lower rate. So instead of tax going up as a result of taxable income going up, tax actually goes down, savings of approximately $8,000.
So wait a minute, Michael. You're telling me that this guy's taxable income went up $20,000, and he's saving $8,000 in taxes.
Right, and that is the power of that chart and those longer brackets, right? Because what was being taxed at 28, 33% is now being taxed at 24%. So a little bit more money, right? Same kind of thing, just making $450. Again, itemized deductions are limited, taxable income is up. However, because of the brackets, they're saving some taxes here.
Oh, no, look, Michael, this is the guy. This is the guy. He's in a higher tax bracket than he was before. This is the guy that's gonna pay more, right?
Right.
Oh. No, sorry.
Right, so higher taxable income, higher marginal tax rate, lower taxes.
Wait, that doesn't make sense. Okay? This is the brackets. That's the power of that stack of income slides we have, okay?
So now we look at a high income earner.
Yeah, we're talking about Michael right now.
Yeah. 750, again, itemized deduction limited. We've talked about that. Taxable income is up. We've talked about that. Marginal tax rate slightly lower. However, because of the stack of progressive tax rates, still saving about $10,000 in tax.
I think, you know, with somebody this kind of income, $10,000 makes no difference. It's just absorbed into their budget, right? But Michael, what happens if that same person's a business owner?
Right, and this is the power of that pass-through deduction that James went through. You know, really getting at, you know, business owners reinvesting in their business, hiring more people, buying capital assets. So same guy, same or gal, same itemized deductions, but this is a Schedule C, or this is a flow-through income from a partnership or an S corporation that qualifies for that deduction. They're getting a 20% deduction on those 750, so they're getting to deduct, $150,000. So their taxable income has gone down, as well as being taxed at lower rates. They're saving real money there.
$5,000. Now, the point of this is, for a business owner, you go, hey, you can leave $75,000 inside the business. What are you gonna do? I mean, the concept here is, you're gonna go out and hire somebody, or you're gonna go out and buy a piece of equipment, okay? And why are you gonna do that? Because the $75,000 is great, but if you hire somebody, you pay them $75,000, okay? Their job is to make you about $150,000, right? You buy a piece of equipment for $75,000, its job is to make you $150,000 or $225,000. So the concept here is that you save $75,000 here, but next year this income number is $900,000 instead of $750,000, and the year after it's $1.2 million, right? This is the whole concept of the Republican orthodoxy about these things, to say we're going to drive the economy by freeing up more cash inside closely held private American businesses. So
Just
growth, yes, the man said, right? That's the concept, right? Grow the economy.
This is, based on the federal law. What happens under Maryland state tax? Maryland.
Yeah, so Maryland is they're going to follow the feds in those things. There's a whole lot of questions about whether they're going to uncouple, decouple, especially with state taxes. But by and large, what you're going to find is the Maryland's not going to give you this deduction, and so you're not saving anything on the state level. You're saving on the federal.
So Maryland is piggybacks on the federal personal exemption, right? So with that done, is that?
That's a really good point. In fact, we're working on doing a kind of a e-blast on that. Right, the Maryland law says that if you take the standard deduction for the feds, you have to take the standard deduction for Maryland. So you could end up in a situation where, yeah, you want to take the standard deduction for the federal because it's doubled, but it ends up costing you a bunch of money at the state level because the state's standard deduction is very small. That's a very nuanced thing. There's been a lot of talk about changing that law, however, they didn't do it in the most recent session. Well, right, sort of there. So yeah, that's all of the end. Yeah. So unfortunately, we don't have the answer.
Maryland state tax planning is impossible.
Yeah. That's entirely true. So if we just take 1 minute to talk about estate planning for a minute, we'll talk about estate trust and gift stuff. We're going to take 1 minute to talk about this. The lifetime exclusion is out, $11.2 million, up from 5.5, so it's basically doubled. That means for a family with $22 million, that's basically you're out of the estate tax. Great. The more important question is clawbacks. There's a lot of discussion that as soon as somebody else takes power, they're going to make that go away. And so why aren't you seeing everybody gifting to try to use up that exemption? I think there's probably sort of thought process that says they're going to go back, the government's going to go back if they decrease that exemption and say, hey, you don't get to do all those gifts, or you have to now pay gift tax. The other thing that's really important is for folks that don't have taxable estates, for a while the step up in basis was going to go away, and I thought it was really underreported. That's really hard for people, right? Think about your parents, right? Maybe your parents had a few $100,000 of house and assets when it was time for them to not be with us anymore. And so without a step up in basis, which had been removed from the bill prior to its finalization, hey, what was your parents' basis in their house they built in 1955? It was like $1,700, right? And it's worth $600,000. So you're going to sell it, you're going to have a $580,000 gain, you're going to pay $250,000 in state taxes, and your parents, everything they worked for their whole life, their legacy to you is decreased by a third, right? And that's every working class family in America, right? It was really important to the MACPA, the AICPA, and people like us to say we need to keep this stuff on the basis for regular Americans. I don't care about somebody with $22 million of assets. They can fend for themselves, right? This is real life people. So that's an important thing. And then the last one is that Maryland was supposed to recouple the estate tax exemption for the state to the feds. It was a 5-year plan ending in 2019. There's a lot of question about whether or not they're going to do that now with the estate exemption doubling. There was a report that said it could cost them hundreds of millions of dollars of revenue to the state of Maryland if they were recoupled to higher.
They capped it at 5.
They capped it at 5?
Yeah,
I didn't see that.
and you do get the portability.
Portability, we'll talk about that. Yep. So we'll leave
So-
that for the professionals.
Yep, and we're just about out of time. So,
Yeah.
in just a summary, who are the winners? And we've talked to kind of beat this. Most individuals, as we saw, because of those tax rates, they're going to see a tax cut. The super winner, as we saw, those business owners that are eligible for that qualified 20% deduction, as we saw in our example. We have losers, but those who aren't going to benefit as much, right? Individuals in high-tax states, maybe not, right? Maybe you weren't getting that state tax deduction anyway because of the alternative minimum tax. And what, the media likes to call investor class, right? So these people with lots of portfolio income may not benefit as much or not benefit
Right,
because,
so folks that are living on dividends and capital gains aren't getting a tax break. Wait a minute. Those people have been getting a tax break since 2000. They've been paying half the rate as the rest of us have, right?
right, because they're losing some of those deductions that we went over. However, they're not going to get a benefit of lower tax rates because they pay long-term capital gains rates, which are lower. So,
Yeah, absolutely.
thank you.
So we'll take one question and we'll circle back.
Suppose you could save money on the federal tax by taking the standard deduction, but you choose not to because that would hurt you on the state tax. Can you do that?
Yeah, that's exactly the question. The question was, suppose I want to take it's cheaper for me from a federal perspective to itemize, but it's cheaper for me from a state perspective to take a standard deduction. Maybe I said that backwards. I said that backwards. You guys got it. Yes, and also there are a lot of people out there working on how to make that work, right? The way it stands now is that you might have to give up some of the benefits at the federal level to make a net savings at the state level. But again, there's a lot of questions about whether or not maybe we can get the state to make some change. So, okay, we'll circle back to that.
All right. Michael, James, thank you very much. I can tell you right now that it is almost impossible to get CPAs out of their offices, let alone on a Saturday. So this is awesome. And I just wanted to say, with regard to the clawback issue, Professor Pinnell at the University of Miami School of Law believes the analysis shows there will be no clawback, but it is a concern. And Gary, while we're switching mics here, do you want to talk about the $5 million Maryland exemption?
Sure. The Maryland legislature, toward the end of the session, did consider the fact that in 2019 they were supposed to recouple with the feds, but they maxed out the Maryland exemption at $5 million. So you have a $5 million Maryland exemption as of next year. It's $4 million if you pass away this year, where you can always leave an unlimited amount of assets to a surviving spouse. And you do have the portability of the Maryland exemption.
All right, we're just going to switch programs here.
Taking a break first? Good one.
All right. I think if you can hear me, we're going to go for 30 minutes because I know you want to hear more of James and Michael. I'm sure you have more questions, and thank you for sticking around, guys. I know you have more questions for the CPA, so Gary and I are going to take about 30 minutes or less. Get my clicker out here. All right, and hope you have your lunch. If you don't, get your lunch, and plenty of coffee. Restrooms are outside to the left. And let's get going on the estate tax, or excuse me, estate planning portion. All right, so we all know where we've come from with lots of changes to the laws over the years. The massive increases in the exemption. And as James and Michael just mentioned, now we have 11.18, or what they were calling 11.2 million exemptions on the federal level, with the federal estate tax still at 40%, but uncertainty due to the Bird rule, which means it only lasts for 8 years, and then it snaps back to the prior level. So we've got 22.5 million between spouses, 11 million for a single person, but it's 2026. Unless something happens, it's going to snap back to the 5.5 million. Gary mentioned the Maryland exemption now at 5 million permanent with portability, which is a wonderful thing, even though it didn't go to the federal level.
One thing I'll add is that once Congress gives you a tax break, it's really difficult for them to take it back. In the early 2000s, pardon?
Speak up here.
In the early 2000s, if you recall, the estate tax exemptions under the federal law was a sliding scale, starting about $1 million in 2000, up to $3.5 million in 2009. In 2010, there was supposed to be no estate tax at all, and in 2011, it was supposed to sunset back to the original $1 million. And of course, in 2010, after George Steinbrenner died, when there was no estate tax, where he left an unlimited amount to everybody, Congress upped it up to $5 million. So also, although because of the Bird rule, it's good for only 10 years, it's supposed to sunset back in 2016, just like these gentlemen said, I think it's unlikely that it will happen, but it really depends upon who's in Congress at that time and who's in the White House at that time.
All right, so kind of what we just said there, estate tax is not going to be applicable to most taxpayers. All right, and so this changes our thinking a little bit, and just to give you a flavor of, these slides are really just to give you a flavor of what are the different ways of thinking about things now that we have these massive exemptions. Are annual exclusion gifts really necessary? Testamentary charitable trusts, in other words, charitable trusts in death, are they really necessary or needed? All right, so only 1,800 people of 2018 decedents will actually owe an estate tax. 1,800 people nationwide, according to the Heckerling Institute in Orlando. But wealthy clients, of course, are increasing their wealth. And then, of course, James and Michael talked about the potential for clawback, which we don't think is going to happen. And, of course, we have the snapback. Planning for non-citizen spouses is still an important planning tool. So that hasn't changed. The generation skipping tax has not gone away because the estate tax didn't go away. So we have even greater generation skipping exemptions.
Which actually gives you much more flexibility if you want to create trust not only for your children, but to require that those assets pass on to grandchildren, instead of letting your children decide to whom their assets in their trust will pass upon their death. So we have much more opportunities for bloodline protection.
All right, so old plans need to be reviewed. I think this is one of the thrusts of the ramifications of the Act, and Gary will have a couple of examples, but I'll just give you one real quickly. A client came to us the other day from a competitor firm in the Washington area. I walked in the conference room, I saw the binder. As soon as I saw the binder, I knew those clients had not been taken care of. And lo and behold, I talked to them, and they said, yes, that law firm has not contacted us since 2003. And of course, they had an old formula clause, which of course was probably the right thing in 2003. It's an older way of doing things, an older way of looking at things, and that needs to be reviewed. And of course, their assets need to be funded and aligned into trust, which of course has not occurred either since 2003. Gary, an example?
Nah.
Okay, that was a good one.
No, honestly, you have a formula trust. What that means is you take a look at the lower of the then applicable federal or Maryland estate tax exemption. You put it into the family trust. That's how all the original plans were done years ago when the exemptions were much lower. The advantage for that is that any assets that remain in the family trust when the surviving spouse dies is exempt from estate tax. The disadvantage, though, is, you're all familiar with the concept of step-up in basis, right? Anybody in our maintenance plan knows what the step-up in basis is? But for those guests here who may not know, if you buy a property for $100,000 in investment property, the IRS calls it a basis. You and I call it a purchase price. If you sell that property, lady, for $200,000, there's a capital gain of $100,000. If, on the other hand, you bought this investment property for $100,000 and you die when it's worth $200,000, when your beneficiaries inherit that property, they don't have to use that lower basis to calculate capital gain should they sell it later. So you get stepped up to the date of death value. In a family trust, when the first spouse dies, although there'll be a step-up in basis when the first spouse dies, and for all my clients, who are always the spouses who die first? Right, the husband's right. Any assets remaining in the family trust when the survivor dies do not get a second step-up in basis. So now that there's much of a lesser need for estate tax protection, you want to try and provide as much capital gains tax advantage as we can for our children. So we may not want to use a family trust automatically first, which is what happens with a formula type of a trust.
And that's a good, yes, sir. Question.
If you, say a person was worth $2 million and lived in Maryland, and they died, do they have to file these estate tax returns in order to get a step up in basis, or does it happen all the time?
All right, so very good question. The question is, to get the step-up in basis when the first spouse dies, you need to file an estate tax return. The answer is no, however, you want to. And the reason is, everybody gets a step-up in basis when they die. But for assets that may get placed into a marital trust, which is how we're doing things now initially, in order for that marital trust to qualify for the estate tax exemption and get a second step-up in basis when the survivor dies, you do need to file the estate tax return, even though the tax will be zero.
All right, so we're going to keep moving on here. Good segue, Gary, talking about the step-up in basis. So you're going to see that the focus of estate planning now is really income tax oriented because it's so easy to exempt so much in estate tax. So with couples with assets under $5.5 million, and again, I know there are single people in the room, so please forgive these illustrations for couples only. Outright to surviving spouse or in trust. Either way, those can qualify for the portability and, of course, marital deduction. And, of course, as Gary just mentioned, we want to get the cost basis adjustment at death. And as we're going to see with Q-tip planning or marital deduction planning, we can get a double step up in basis. Couples with $5.5 million but up to $11 million, same types of things, outright. Assets left in a marital trust, and many of you know what that is. We call that a Q-tip trust, a qualified terminal interest property trust. Now, we don't have to use a Q-tip trust. A Q-tip trust is, and we're going to talk about what that is, but it's really for surviving spouse only to qualify for the marital deduction. So what if somebody says, I want to leave assets and I'm not so worried about the estate tax exemptions anymore, but I want my kids also to be beneficiaries. Well, we can't use a Q-tip trust for that. We might use what we might call a Q-tipable trust, a trust that is for wife or spouse and husband or wife or descendants all together, but it could be income only as to the spouse. So remember, a Q-tip trust can be income only or it can be income in principle to the surviving spouse. And of course, portability, the simplification of estate tax planning. So that's been around now for about 6 years. You now have 24 months to make the portability election after the death of a spouse. 24 months, it used to be 9 months, it kind of scared me a little bit when they said 24 months, but I think they mean that. And that requires the filing of an estate tax return to make that portability election. And as Gary talked about, the basis adjustment. Okay, assets, couples with assets over 11 million. There certainly are people in that category. Same as the prior category, gifts are used to increase the exemptions, but we have to be concerned about the snapback, which may happen. And of course, there's issues about how that's to be structured for access to the grantor or access for family members. All right. Now, let's talk about, again, married folks that are leaving assets outright to a spouse. It's simple, but there's no asset protection. So that's something that, with so much to think about today other than estate tax, we can think about things like asset protection. There's no marital protection. So my experience, and Gary will comment on this, my experience has been that younger couples are not so worried about this, couples that are 50 and under. But again, 80% of couples 30 to 45 don't even have any estate plan. So it's couples 50 and over, 60 and over that seem to be concerned about marital protection. So if I want to make sure that my assets go to my children or make sure it goes to where I want it to go, my nieces or nephews, I have to use a trust, and that trust will protect against potential bad spouses or remarriage. And of course, we're going to talk about that in a little bit more detail. Gary, any comments about marital protection?
Right, here's what can go wrong, especially if it's a second marriage for one or both spouses. If you have children from a first marriage, and you're now remarried, and you leave assets outright to a surviving spouse, what could happen to your own children upon your surviving spouse's death? They may end up leaving it to your stepchildren, and then your children are out of luck. So with an outright distribution, especially with couples who are in second marriages with children from their first marriage, usually an outright distribution to a surviving spouse is not something, once the clients are educated about it, that they would want to do.
And we're going to talk about leaving assets in trust, which many of you have already been well educated on, but this is going to be a reminder. And of course, with the state having lower exemption amounts, we have to consider that in this process. All right, so another popular technique, of course, is outright to surviving spouse, but using a disclaimer method to do estate tax planning. Now, do we need to worry about that on the federal level? Not for 99% of people anymore.
What's a disclaimer?
What is a disclaimer? Well, here's a good example. My grandmother died years ago, and she had spent all of her money on long-term care. So, but she had a tiny bit left, and she left me $5,000, and I was very happy to have received that. Now, if I didn't want that $5,000, which of course I did, but if I didn't want it and I wanted my child or someone else to receive it, I could have disclaimed that property. I could have said, I don't want this. I'm going to sign a paper that says I'm disclaiming it, and therefore it will pass by law to someone else. Well, in estate planning, you can use disclaimers with documents. You can use them to say, well, I, the surviving spouse, received an asset, but I'm disclaiming it. And the documents control where the disclaimed property goes. So this is an old-fashioned technique that's used for estate tax planning that is no longer needed because of these huge exemptions for most people. So anyway, there are some disadvantages to this technique, even if it were needed for Maryland purposes. The surviving spouse may refuse to make the disclaimer. The surviving spouse might be incompetent. They might die. They may accept the benefits before they disclaim it. And again, this is not a big issue today because of the huge exemption amounts, which make disclaiming not so important. For Medicaid purposes, this could be a problem. If a surviving spouse receives assets and disclaims it, the government or the state government could say, wait a minute, that's a transfer of assets for Medicaid purposes. Also, for asset protection purposes, if the surviving spouse receives money and disclaims it, but has creditors, the creditors could argue that is a fraudulent transfer. But anyway, this is not a big issue for most people today.
Yeah, one of the important issues in estate planning is not just the trust, but also the powers of attorney. So let's take an example. Let's assume husband and wife are in a car accident. Husband dies, wife survives, but is permanently disabled and legally incompetent. Let's assume also, though, that based upon their estate plan, it would have been advantageous to have exercised a disclaimer. With a Maryland financial statutory power of attorney, one of the choices that you can make is that if you are incompetent, legally disabled, that your agent who you've appointed can make a disclaimer for you. So generally, at least the clients that I see, and I'm sure you do the same thing, we always want to make sure, particularly if it's a married couple, that on the power of attorney, you allow your agent to be able to disclaim on your behalf, so that if the surviving spouse is disabled, the surviving spouse is able to take advantage of the disclaimer planning.
That's a great point, Gary. Now, let's talk about the advantages of trust upon the death of someone. It provides management, of course. It can implement limitations on the beneficiary if any people need such limitations. It provides control for you, the grantor, when the trust is completed in the future, if you want that control. It protects from the claims of the beneficiary's creditors. Now, at the end of this presentation, we're going to talk about a couple of cases I want to bring to your attention that are kind of making us look at this a little closer. But generally speaking, spendthrift protection and further trust planning protects against the claims of creditors. Especially this next one is what we're concerned about, divorcing spouses and ex-spouses. There's a new case I want to bring to your attention, in a Massachusetts case, that's kind of got us a little worried about that. But there's ways of dealing with that. There's possible state income tax savings, and of course you can build in flexibility. All right. Now, what is a direct bequest to a discretionary trust for a spouse? So, let's pretend that someone has $5 million left, still a lot of money, And this person says, well, I'm not worried about estate tax, I'm not worried about controlling the assets to my beneficiaries after my spouse's death. So I'm not worried about the Q-tip or the marital trust rules. And I'm not even worried about the 2026 snapback. I'm not worried about any of that. They can just leave assets in a discretionary trust for a spouse or perhaps children. And because of these huge exemptions, it simplifies things. So not everyone's worried about marital control, but you could simply use a simple discretionary trust. All right. So what Gary had talked about earlier, this is a very quick slide, is that in the old way of thinking, when someone would pass away like that example I gave you from 2003, there was a traditional credit shelter or bypass trust built into that plan. In today's planning, and Gary will speak to this, the conventional wisdom is that for 90% of people, that is not a good way of going. That is an old-fashioned method of planning. We want to go between spouses. We want to use the portability method of planning, using the marital deduction, where we have $22 million of exemption, a double step up in cost basis, because in the old way of thinking, with the bypass or credit shelter trust, we only get one cost basis adjustment, as Gary was talking about. But there are 10% of people who say, I not only want marital control, I want it to require extramarital control. I want to require a prenuptial agreement. I want to require my surviving spouse to have to get a prenuptial. So if you are a person who wants that kind of marital control, we still would use what I would call the old-fashioned method, even though it's not income tax advantageous. It's not as advantageous for income tax. Gary, any comments?
One of the things you want to keep in mind is for trusts that will qualify for the unlimited marital deduction, there are basically three requirements. Number one, the only beneficiary allowed is the surviving spouse. Number two, all the income must, as a matter of right, pass to the surviving spouse. And number three, this is a technical thing, which I'm sure is in every one of your trusts, but it never becomes relevant to real life, that the surviving spouse can require of the trustee to convert non-productive or non-income property to income-producing property. One of the things that you can put into a Q-tip or a marital trust is, if the surviving spouse remarries, you can actually freeze the principal from the surviving spouse. Sort of draconian. Some of my clients like it. However, what you could do to make sure, because you did the thought would be, well, if my spouse is remarried, I want to preserve everything for my children. You could build into the trust, number one, a restriction that the surviving spouse remarries, no principal. You can also put in that if the surviving spouse's marriage terminates, whether by death, not by your surviving spouse, but by husband or wife, or divorce, you can then unfreeze the principal. So you can put those things in there. and still control the principal even though it's a marital trust.
There's a question.
If you do that, I guess the income passes through for income tax purposes. The income passes out of the trust and isn't subject to the high trust rates. Is that
For
correct?
any income in a trust, if it's a marital trust that passes to the surviving spouse, the income tax will be in the surviving spouse's estate and it won't be subject to the trust income tax rates. So let's assume you have a trust that requires income to be paid to the beneficiaries, or even as discretionary, if the income gets paid out of the trust, then the income on the trust income, the income tax rates, or the income will be reported on the beneficiary's income tax returns.
All right.
If you have capital gains in the trust, you're gonna be stuck with that unless you say that's income, right?
Well, I'm not saying if I can, but for our experts here on that question.
It depends.
See, that was what I was going to say, but he said it much more artfully than I would have.
Honestly, it depends on your personal situation, and it depends on a lot of things, especially under tax reform, you have a lot of questions about rates and itemized deductions and all that sort of thing. So maybe we can talk about the specifics offline after this.
All right, we're going to keep moving, just in the interest of time. The thing to take away from this slide is that with portability, which again, 90% of people should use portability today unless there's a good reason not to if you're married, is both exemptions are available, and we have a step up in basis at both spouses' respective deaths. Now, there are possible advantages of the old-fashioned method. Let's just cover that real quick. There's a potential for substantial appreciation. So I was meeting with a client the other day. He's a young entrepreneur. And the question with his group of advisors was whether his business interests have the possibility of really growing after his death. And they concluded, since he was the key person of the business, it probably wasn't going to grow. But if he had some significant possibility of growth in his business after his death, or his business assets, the old-fashioned credit shelter way of doing things would have been better, because that allows those assets to be frozen in the future, and for estate tax purposes, there would be no estate tax on the increase. There is increased remarriage protection. We talked about that. And surviving spouse and descendants can be beneficiaries, not just the surviving spouse. All right, so we need to move on, Gary. We'll just keep going. Now, back to Q-tip trusts. What is a Q-tip trust? Well, it's trust planning after one spouse's death. There's portability. Remember the 2 years and check the box on the estate tax return to choose portability. Okay, qualified terminal interest property. Qualified terminal interest property.
That's a fancy way of saying you can create a trust for the benefit of your surviving spouse, but the person who created the trust and not the surviving spouse can control where the remaining assets will pass upon the death of the surviving spouse.
And you can give your surviving spouse income only, or most couples would say income and principal. And of course, the Clayton election is something that many of you have in your documents, which is the flexible approach to the future. I have 15 months to make the Q-tip election my independent personal representative. But if that election is not made, then it automatically goes back into the old-fashioned bypass trust or credit shelter trust. And of course, you don't have to use the Clayton election. You can have what we would call a straight Q-tip approach for spouses. All right. When we do Q-tip planning, as Gary was mentioning, it requires the filing of an estate tax return. So as opposed to leaving assets outright, no asset protection, you don't have to file an estate tax return. With Q-tip, we do have to file an estate tax return. There's a basis adjustment. Now, most of the time, we would not give the surviving spouse a general power of appointment, meaning the surviving spouse can leave it to whoever they want. I mean, why do a Q-tip if you're going to allow the surviving spouse to be able to do that? But you could have the advantages of the Q-tip, and you could let your surviving spouse give it to whoever they want. But most people would not do that. All right. For estates over $5 million, we want to lock in the deceased spouse's unused exemption amount. Okay? And that's just something that we would make sure of. Again, we have 15 months to make the election. The Q-tip election can be made by a formula. So there's ways of doing that. We won't get into the reverse Q-tip election, but there is a state-only Q-tip election, and Maryland is one of those states that allows that. So that's something that should be discussed as part of planning. And Gary, any comment here before we move on? I want to make sure that James and Michael have the chance to get back up again.
Yeah, I think that's the most.
Okay. We won't get into this at this point. We're running a little bit out of time. But this is talking about how you could use trust for the surviving spouse, but still give them all kinds of flexibility. And most clients I deal with would not want to give their surviving spouse that kind of flexibility to give assets or have unlimited access to principal. But it is possible in today's environment to do that. State exemption amounts, we'll just very briefly again, $5 million for Maryland. DC, I believe, is adopting the $5 million. Gary, have they adopted the actual federal exemption?
DC, I think, is now up. Last I read, I thought it was either 5 or the DC exemption.
Yeah,
$5 or $11 million. I don't recall, but it was.
All right. All right, again, other techniques for state estate tax. So with our state estate tax being capped at $5 million, there still needs to be planning for many of you with state estate tax issues. So that's going to be something that's ongoing. All right, so there's an emphasis on flexibility, using powers of appointment, which we won't have a lot of time to get into today, providing for independent trustees. Many of you know we've had that discussion about interested versus independent trustees, and trust protectors, which Maryland refers to in the Maryland Trust Act as trust advisors, but nationally this is a flexibility mechanism known as a trust protector, someone with modification powers. These are things to build in because we don't have to worry about estate tax. We have a lot of other things to focus on. All right. I want to make sure James and Michael get back up, but again, basis adjustment planning. This is a big thing, okay? James talked a lot about taxes and the tax brackets and capital gains. We want to make sure in doing planning, we don't lose out on basis adjustment. Let's talk about creditor problems, okay? Now, when you give someone a general power of appointment, you give them the ability to be able to give assets to basically whoever they want at the termination of a trust. What's the problem with the general power of appointment? Well, there's potential creditor problems. So creditors can argue that if your beneficiary has a general power of appointment, that creditors can attack that trust. Because basically they can say they stand in the shoes of the beneficiary. And in some states, case law would indicate that, well, that's not true. The beneficiary actually has to exercise the general power of appointment for the creditor to attack. But generally speaking, general powers of appointment, even though they provide flexibility for basis adjustment and so forth, they're not good for creditors. So generally speaking, we want to have a limited power of appointment and not a general power of appointment.
One of the things you can do with a limited power of appointment is allow your surviving spouse or the beneficiary to leave their assets to anybody who they want other than their own estate or their creditors. And that's one way of giving them maximum control, but still protecting the assets in the trust from claims of creditors upon their death.
There is this philosophy now that maybe we should give gifts to surviving or living parents. So if you are wealthy and you give gifts upstream to family members, then at their death they can leave it to you at a step-to-step basis. So what's the problem with that? Well, they might not leave it back to you. When all of these things are being discussed now. All right. Again, I want to get the guest speakers back up here. We won't spend a lot of time on this slide.
How many of you have taken speed reading courses?
We're running out of time, so I've got a fast finger here. All right. A lot of times when folks would make gifts, we're worried about appraisals not making sure they haven't used more than their exemption. Now, with all of this exemption, we have cushions, and we're not worried about as much of these types of issues as we were in the past. Okay, so we can give gifts to trusts, we can equalize gifts, we can make sales of businesses to trusts, and so forth. There's all kinds of complex strategies that can be used because we're no longer limited by low exemptions. All right, spousal lifetime access trust. This is just a gifting trust where the spouse and descendants or other beneficiaries can be beneficiaries, not just a surviving spouse or a living spouse, I should say. Lifetime Q-tip trust. This is one of our biggest asset protection opportunities in Maryland. So we talked about a Q-tip trust in death for spouses, right? But you can also have a lifetime Q-tip trust. Maryland is not one of the asset protection states, so to speak, like Delaware or Nevada or South Dakota. But if you give a gift in trust for your spouse and make it a lifetime Q-tip, Gary will talk about this, you can do excellent asset protection in Maryland during life. Gary, any comment on the lifetime
You
Q-tip?
can create a trust to benefit your surviving spouse. The surviving spouse gets all the income as much as the principal that the surviving spouse needs, but any claims against her, any creditors cannot attack the assets in that trust. And also that the spouse who has created the trust can control where the assets will pass upon the spouse's death.
All right, we talked about upstream gifts. We're not going to spend a lot of time on that. Audits. Normally, of course, the CPAs would advise us, we want you to file a gift tax return if you make a gift. But my understanding from Heckerling is that the audit rate is still very low on these, and it's not rising. James, do you have any comments about the audit rates?
Yeah, you know, the audit rates are predominantly a function of IRS funding, and the funding is being limited more and more all the time. We're seeing more emphasis on examinations of partnerships and those flow-through entities that we talked about, which have historically been audited at a rate of less than 1%. So if you assume that there's the same pile of money and there's more going towards operating businesses like partnerships and S corporations, that tells us we don't plan to see increases in the other stuff, whether that's individuals or trusts or estates.
By the way, Steve has mentioned Heckerling a few times, so for all of you who don't know what Heckerling is, University of Miami School of Law, in honor of one of its former professors,
Gary's alma mater.
Every year has basically an annual convention of all estate planning attorneys. It's like a collegium where we all get together and we think deep thoughts, just like the Tin Man does and Wizard of Oz, and we talk about new types of estate planning techniques. So it's usually a one-week collegium in the University of Miami, and I will tell you that when I was in law school, the first 2 years at the University of Miami, I took Professor Heckerling for taxes, and never in a million years would have thought that 40 years later I'd be going to one of his memorial collegiums. Because he was a great tax lawyer professor, but he didn't sound like a professor. He sounded like a down-to-earth type of a guy who happened to think deep thoughts.
That's very good.
Heckerling Institute is.
Very good. So the theme of most of these slides is that prior planning needs to be reviewed. We need to keep this potential snapback in mind. And now wrapping up, and hopefully we have just a few minutes for these other speakers to come back up. We want to make sure that we're still talking asset protection for those of you who are interested in this. There's never been a greater time to do asset protection planning now that we don't have to worry about the exemption amounts. So we have basic asset protection during life. Most of you know those concepts. We have domestic asset protection trusts. Even though Maryland, you can't do a domestic asset protection trust, you can do a lifetime Q-tip trust between spouses and have just as significant asset protection. And then, of course, there's asset protection at death, which is very easy to do in plan. Asset protection at death is easy. But again, I want to emphasize between spouses the lifetime Q-tip trust. Now, if you look at this last bullet point, divorcing spouses, bankruptcy, and lawsuits, what am I worried about the most today? Divorcing spouses. Oh, there she is. Okay. Close your ears. Okay. All right. This is a case I want to bring up to you, and I'm sorry we're out of time, and I'm going to bring up the speakers. But if you look at these two Massachusetts cases, especially the 1991 Massachusetts case, this is being talked about at Heckerling, and here's why. And for those of you who want to see this case, I'll be happy to send it to you, along with the video from last night. All right, these are cases, and Massachusetts seems to be making a lot of headlines these days. Headlines in Medicaid law, and now headlines, even though that's an older case, headlines in spendthrift trust law. So basically, to make a long story short, Massachusetts court allowed the invasion of a spendthrift trust. And you'll have to read the case, but it was a divorce case where father had died, mother had died, and left a trust for their son. And the trust held real estate, and the son was living in the real estate, the real property, with his spouse. And long story short, when they got divorced, or in the divorce proceeding, the judge overruled a lower court at the higher court level and allowed the spouse to have actual invasion of the spendthrift trust. So I know that many of you, this is the nightmare scenario that you are trying to avoid. So when we establish those spendthrift trusts for your children or nieces and nephews or others, you are building those trusts very conservatively so that they cannot be invaded by bad spouses. Okay, so the case law seems to be shifting a little bit. Now, I'm not saying this would happen in Maryland, but the case law seems to be shifting where it's possible that a divorcing spouse could penetrate an irrevocable spendthrift trust. So what can we do to avoid that?
Not live in Massachusetts.
Not live in Massachusetts. Now, I brought this up to someone. It's really weird. I had a former colleague who has a Massachusetts trust. And I actually met with them yesterday, and I brought this up, and they did not want to change the state law to Maryland, which I thought was a mistake. But anyway, this is not to say that a Maryland court is going to follow this. This is not to say that. But when we are structuring trusts, if we use independent trustees, and if we make sure that the trust is pretty tightly construed, that it's not sending out staged distributions to the beneficiaries. It's very tightly construed, which has to do with the Harris and Carpenter cases. And many of you have talked with us about this in the conference room. Just know that there is this unfortunate trend toward this possibility. But I think if you use independent trustees and keep the trust very conservative, using limited powers of appointment, and making the trust a dynastical trust, you can prevent against this possible problem for divorcing spouses. Gary, any comments? All right. James and Michael, would you come back up again? And I know we're out of time. You're very patient. Are there other questions for James and Michael?
Sure, well, just one quick thing. I think, firstly, thank you for having us, thank you for putting up with us. And I think, more importantly, what you're hearing from these fine folks, and I think why you're here, go back to what my dad, who was a Marine, always called the 6 Ps, right? Proper prior planning prevents poor performance, right? You guys should be commended for being here, spending your Saturday trying to figure out what's the right thing to do for your family. So for that, thank you. Thanks for having us. Do we want to try that capital gain question was that the question we had back there? The one?
Yeah, Bill, I want to hear your question.
Sure.
I'm looking in Maryland that if you kind of stay otherwise in a trust, dividends and interest are income and capital gains are capital.
Yeah, corpus.
And
Yeah.
I'm wondering, could you change that and say in the instrument that capital gains are income and shift all that out of the trust as non-trust aspect?
Yeah, that's actually a very nuanced question. Michael? So, let's go back. So it's a question I think most of you heard. The question is, hey, in a trust in its standard kind of format, interest and dividends are income and capital gains are a portion of corpus, right? And so what you have there is, again, that independence question. In a simple trust says you have to distribute all the income. You get down to this question of what is capital gains, is it income or is it corpus? The general sort of thought process is it's corpus. In a complex trust, the same sort of thing stands, and you'd say, okay, if I've got $100,000 of interest in dividends, and I distribute $120,000 to the beneficiary, Well, basically, the first 100,000 is the interest and dividends. They get a K1 that has that income. They pick it up on their individual return, which is more tax efficient because the rates at the individual level are better than the rates at the trust level. So then you say, okay, what else did I give them? I gave them $120,000. My income was $100,000. What did I give them? Did I give them corpus? Or can I allocate them the capital gains at long-term capital gains rates, which would be more efficient, again, at the individual level? To some degree, that can be, at least in a complex trust, can be controlled or implied by the trust document. Many trust documents, or some trust documents, I guess maybe, and especially specific to Maryland and Maryland law, many say that if you establish an accounting method that says that the capital gain is distributed over and above the income, right? The income's always going to go first. Capital gains distributed over and above the income, if you set a precedent of treating that as applicable to the beneficiary, then you can flow it through. But it's very nuanced, and if that's something that you're thinking about, you should definitely want to get together, think about how to get that into the document, because it really is a kind of substance over form sort of thing where you set a precedent and then you have to follow it. You can't look back and forth. Very complex question. Thank you. Anybody else?
Is there any other questions for the CPAs while you have them here on Saturday?
Hold on, anybody else that raise their hand first? Okay. Talking about cushions, suppose somebody had an estate that was worth, say, $1 million. And they're gonna file estate tax returns in Maryland. They need to get appraisals done.
That's probably more of a legal question, but I know what I think.
Well, we always want you to get an appraisal. I mean, is that what you would say, James? We always recommend that you take the high road there and get appraisals before you make gifts. And I had a question, James, about alimony.
Oh, sure. Hey.
So this is not, hopefully not going to affect anybody in this room, but for their children and nieces and nephews. I mean, this is a huge deal. Can you comment on that, the new alimony?
Yeah, so for years and years and years, that when people decided to go separate ways, and that alimony was apportioned as a function of the divorce decree. It's not marital agreement, it's not I'll pay the bills, it's not I'll pay for private school. It's alimony as defined as alimony in the divorce decree, okay? The payer of the alimony, normally the higher income earning ex-spouse, pays the other person, they get a deduction, okay? And now, again, the IRS is clever. They made you on the form actually show that person's name and social security number, right? Now, the recipient of the alimony, again, normally the lower income earning spouse, had to pick up that amount of income on their tax return. And again, the IRS knew that because it was on the other spouse's tax return. That's now been changed starting in the 2019 year, if it's written into the agreement appropriately, where there will be no deduction for the payer and no income for the recipient. That is something where, we're not attorneys, certainly not divorce attorneys, but we see these things. And so there's a lot of folks that are, kind of looking at it and going, gosh, do I need to, or do I either need to think about what I'm doing or modify the agreement that I currently have? You might have a situation where you had a high income earner or a doctor or something like that, and they're getting towards retirement, and they go, wow, I need to reevaluate this alimony situation because when I retire, my income goes from $400,000 to $200,000, and I'm supposed to be paying $125,000 in alimony, and I'm not getting a tax deduction. I'm living on cat food, right? $75,000 a year isn't going to work, right? And so that's where you have to start looking at it, and you got to start looking now, right? Because it's going to take some time to work through that process. So yeah, that's sort of 1119 as it's here.
Let me expand on that a little bit more. That at least in Maryland, there are alimony guidelines that the court has, and what the guidelines take into account, at least they have until now, and they will till the end of this year, is when you take a look at the guideline amount, they take one of the things that you consider, or one of the things that the court, the legislature considered, was the income of each of the spouses. So they calculated into the alimony payment, how much the recipient and how much the payer would have after taxes. Now, the issue that you had, that once the doctor goes from $400,000 to $200,000, is the same issue regardless of what the tax change was, because whether you're taking the deduction or not, you're still going from $400 to $200, and you're still under an order or an agreement to pay something less. So that always, I think, had to be addressed in a separation agreement or in a divorce decree. Usually when there are agreements between husbands and wives about permanent alimony that doesn't change, I would think that the practitioner would keep into account that there will be an automatic adjustment at the time that the paying spouse is no longer working.
For sure. Yeah, well, pro novice, right? Pro novice, yes. Okay.
All right, well, we'll end it there unless there's other questions because we've been very patient.